Hey everyone, welcome back to the Explainer. So, if you're the kind of person who loves piecing together timelines to just kind of make sense of the big financial picture, well, you are absolutely in the right place today. We're unraveling IAS 10 events after the reporting period. Now, I know it might sound like just another dry accounting standard at first glance, but honestly, it's basically the forensic science of accounting. It's all about figuring out exactly what belongs in the past, what belongs in the present, and how we handle those really ambiguous, often chaotic weeks right after a financial year ends. It's an absolutely crucial framework designed to protect the integrity of financial statements. So let's solve this post-reporting mystery together and see exactly how these rules play out in the real world. To get us started, I want you to picture this scenario. Your company's financial year wraps up perfectly on December 31st. The books look great, the whole team is happy. But then an unexpected tragedy strikes. Right in the middle of January, a massive fire burns down your main warehouse. I mean, it's a devastating loss for the business. But here is the critical question for accountants. Does this January disaster actually affect the financial books for the year that just ended? You see, financial pros have to constantly ask when an event actually occurred and what impact it has on the reporting period that officially just closed. Keep this specific warehouse fire scenario in your head, because we are going to solve this exact case by the end of our explanator. Okay, let's dive into this. To solve any timeline mystery, we first have to establish our boundaries. Let's say your financial year ends on December 31st. That is your formal reporting date. But, finalized financial statements don't just magically appear the very next day. It takes time to compile, audit, and review all of that data. So let's assume your board of directors officially reviews and approves those final statements weeks later, say on February 20th. And then, even later, on March 23rd, you hold your annual general meeting, and the info goes totally public to the shareholders. This timeline right here is our map, and understanding the gap between these specific dates is literally the entire key to IAS 10. So the specific period we actually care about for IAS 10 is strictly between the reporting date, that December 31st mark, and the date the board of directors approves the statements, February 20th. That exact window is what we call the events after the reporting period. Now, you might be wondering, why is this so absolutely critical to define? Because anything, and I mean anything, that happens after February 20th is completely out of scope. The books are closed, the standard doesn't care about what happens in March or April, it only cares about the events that unfold within this one specific, critical window before that final seal of approval is given. All right, now that we know our window, we've got to look at what actually happens inside of it. During those few weeks between December 31st and February 20th, a vast amount of new information can come to light. And IAS 10 cleanly categorizes this new news into two core types: adjusting events and non-adjusting events. Your entire job when applying this standard is to look at a piece of news from January and decide which of these two buckets it falls into. But to tell them apart reliably, we can't just, guess based on how big or scary the news is. We need a foolproof golden rule. So, the crucial point is, we rely on one defining question. Seriously, burn this phrase into your memory. Did the condition exist at the reporting date? This is your ultimate litmus test. Whenever a major piece of news breaks in January, you have to stop and ask yourself, were the underlying conditions already present on December 31st? Was the root cause already sitting there, just waiting to be discovered? This simple mental framework guides you to the right answer every single time, stripping away all the emotion of the event and focusing purely on the timeline of the condition itself. If the answer to our golden rule question is yes, well, then you're dealing with an adjusting event. This means the underlying condition absolutely did exist at the reporting date. The clues were already there at year-end, we just kind of didn't find the concrete proof until a few weeks later during that IAS 10 window. Because the roots of the event were firmly planted in the past year, we are required to go back and actually adjust the numbers in the financial statements to reflect this new reality. Let's look at some highly tangible examples to make this crystal clear. Let's walk through some classic adjusting events. Say a major client owes you $500,000 on December 31st, sitting proudly in your books as a trade receivable. Then, boom, in mid-January, they declare bankruptcy. Applying our golden rule, did the condition exist in December? Yes. I mean, companies don't just go bankrupt overnight, right? They were likely already in deep, terminal financial trouble back in December. The January bankruptcy just confirmed the doubt that was already there. Therefore, you must go back and adjust the December books to write down that receivable. The exact same logic goes for inventory. If you sell specialized seasonal tech inventory in January for a massive markdown, it provides concrete evidence that its true net realizational value back on December 31st was actually way lower than you thought.
And naturally, if you discover a material calculation error in January, you absolutely must adjust the December statements to fix it. On the flip side, what if the answer to our golden rule question is no? Well, then you are dealing with a non-adjusting event. This means the condition arose entirely after the reporting date. There were absolutely zero clues or root causes present on December 31st because the event simply hadn't happened yet in any shape or form. It's a completely new development that belongs entirely to the new year. And because it has nothing to do with the economic realities of the past year, we absolutely do not touch the financial numbers of the past year.
Which brings us right back to our original hook, the January warehouse fire. You're the detective analyzing the timeline here. Look at the facts and apply the golden rule. Did the condition of the fire exist on December 31st? Was the building already burning on New Year's Eve? Assuming it wasn't a fire that had been smoldering unnoticed for weeks, the answer is a definitive no. The fire started in January. The condition simply did not exist at the reporting date. Therefore, fires, earthquakes, and other sudden natural disasters that happen in the new year are strictly non-adjusting events. They arose entirely after year-end. Another phenomenal example from the standard is a sudden decline in the fair value of your investments. Let's say you hold significant stock in another firm, and the broader market just crashes in mid-January. Well, that is a January problem. The macroeconomic conditions that caused the market to tumble in January did not exist on December 31st. Because of that, you do not go back and write down the value of your investments in the December financial statements. The numbers stay exactly as they were valued at year-end. Now, what's really interesting about this slide is how the incredible nuance of this standard shines when we look at fraud. Imagine a situation where a company cashier is caught stealing funds. Exactly when the theft occurred dictates everything about how we report it. If they were quietly stealing money throughout November and December, but the internal audit only caught them in January, well, that's an adjusting event. The condition, the missing cash, existed at the reporting date. You have to adjust the December books to record that loss. But if the cashier was entirely honest up until January 5th and only began stealing then, that is a non-adjusting event. The theft occurred entirely after year-end. It's the exact same crime, discovered in the exact same month, but it requires completely different accounting treatments based purely on our timeline rule. And this brilliantly illustrates exactly how you close the case regarding reporting requirements once you've identified your event. For adjusting events, it's double duty. Yes, you go back and physically adjust the numbers in the primary financial statements, and yes, you must disclose what happened in the notes. For non-adjusting events, like our January warehouse fire, no, you absolutely do not touch the numbers. You leave the balance sheet alone. However, if the event is material, meaning it's significant enough that shareholders need to know about it to make informed economic decisions, you still must disclose the nature and estimated financial effect of the event in the notes. You clearly communicate to investors that the warehouse burned down, sure, but you do not change December's reported profit. So, we've covered the defined window, the golden rule of existing conditions, and exactly how to close the case with proper disclosures. But I want to leave you with one final, provocative thought to really test your mastery of this timeline. Imagine a massive, devastating earthquake hits your company's primary manufacturing plant, but it happens the exact day after the board of directors officially approved the financial statements in February. Based on everything we just learned about the strict IAS 10 window, what does the standard say you must do to those approved statements? Think about it. The window is officially closed. For IAS 10 purposes regarding that past year, you do absolutely nothing. It is entirely a problem for the current year's reporting. I hope this explainer made the post-reporting mystery crystal clear for you. Stay curious, keep applying that golden rule, and I'll catch you in the next explainer.